What's up, tax savers? So we're continuing our discussion on the new tax reform bill and what is coming, what might be coming down the pike based on how much they reconcile the differences between the two bills that have passed already in the House and the Senate. And today we're going to share details around how it affects your home, both on the mortgage interest deduction and on if you wanted to sell your principal residence. So first, let's discuss the mortgage interest deduction. And I've got my notes here to make sure that we're accurate because, as I said last time, something that just came out a week ago, I can't yet be an expert on 100%, so I want to make sure I'm getting those exact numbers here. So under the bill, the proposed bill, how it's going right now, as it used to stand, so as it stands through the end of 2017, you can deduct your mortgage interest on your itemized deductions up to the value of your home at $1 million. So that means if your home is worth $1.2 million or your mortgage is $1.2 million, you'd get 1 million divided by 1.2 as a percentage of your mortgage interest deduction. So that works out to 83% of your total interest is deductible. If you have an $800,000 mortgage, then all of your interest is deductible. Now they're going to be dropping that $1 million limitation to $500,000. So that means if you've got an $800,000 home, what used to be all of your interest is deductible, now only 5/8 of that will be deductible, 500 divided by 800. And so that, for those in big income, in high value, real estate value areas like LA, Bay Area, New York, Boston, big expensive cities, your mortgage interest deduction, if you've got it above that $500,000 limit, is going to be reduced potentially significantly. And what this effectively does, when you combine that $500,000 mortgage deduction limitation with no more state income tax deduction and the increased standard deduction, almost no one, unless they give away a whole lot of money in charity, is going to be itemizing their deductions. So that's related to your mortgage interest, how that's going to change. Related to your home sale, and we touched on this in a previous video, if you sold your principal residence, you get a $500,000 tax-free gain if you're married filing joint, $250,000 if you're single. That $500,000 tax-free gain is staying, but the old qualification period was you had to live in your home for at least 2 out of the last 5 years. That's now going to switch to 5 out of 8 years. And I'm looking at this, and it's the same on both bills. So that's pretty much a done deal. It starts at midnight on January 1st. If you've lived in it 3 or 4 years, or 2 or 3 or 4 years, and you're thinking about selling your home, you'll want to close that escrow before 12/31. And under the House bill, the $500,000 gain phases out dollar for dollar for if your income is above $500,000. So if your income is $800,000, your annual household income, not what you make on the sale of the home, if it's $800,000, you lose $300,000 of that gain. So it really does affect your sale of your home based on how it is before the clock strikes midnight and that ball drops on New Year's Eve. So that's how it's going to affect your home as it relates to taxes. We'll be breaking down more in the future, and we'll see you next time.